So you want to be the first to know what's happening with home values in the real estate market. Well, I'm Justin Martin on this month's edition of Keeping Current Matters and the National Housing Market Update. We're going to tell you the tale of two markets because that's exactly what's happening across the nation when you look at the buyer demand and or supply of those selling homes and how it's impacting home values. Now, before we get kicked off, as always, we need to make sure that people are listening to the experts and not the headlines, because headlines do more to terrify than clarify. And what do we mean by that is the use these days of terms like buyer's market, seller's market, to make sure that we define a market. And what we are all working towards longer term is a more neutral or balanced market. Is in general, a housing market with 5 to 7 months of supply could be described as a balanced market, healthy market between buyers and sellers. Right now, you're hearing a lot of people speak to today's market as a buyer's market, whereas you look at the months of inventory, homes for sale is exactly the way to define. And again, how many months would it take for, if no new homes came to the market, all the existing homes to be sold to where there was no available inventory? And as you can imagine, if there's only one home to purchase, home values would go up quite high with the amount of competition or demand. And as you remember, the last time we actually saw a true buyer's market where there was a likelihood or probability that year over year home values would dip, you see right now we're seeing small moments or markets where home values may be dipping a little. But I'm going to give you a very interesting statistic on how much they've rose over the last 5 years to where that dip actually is nominal to nothing. So remember, last time we actually were in a buyer's market was back in 2006, 2010, where we saw a mortgage crisis. And since then, we saw an undersupply of homes being developed by new builders. We still are about 9 years. And in fact, on this market update, we were explaining we're about 2 to 3 million homes still needed to get close to a balanced market. So what happened after that crisis all the way into 2020? You can see we entered into an extreme seller's market. Y'all remember the bidding wars, the paying over value, low interest rate. Remember, that is the challenge of what happens when low interest rates combined with low inventory. They drive home prices up at an unaffordable and not a healthy rate of home price appreciation. We are still in a seller's market. That doesn't mean should you sell, should you buy. Remember, you should do those things when you're ready and after talking to an expert to learn about the market and strategically make the right decisions when the time is right for you. But let's use these terms correctly. A seller's market, there's a high probability that home prices year over year are going to continue to rise. And right now in the nation, we are still in a seller's market. And in many markets, as we talked about today, the tale of two markets, there are still many of them that are even at lower supply and more likelihood of home price appreciation and or upward movement in home values. So as we talked about the tale of two markets, since the national pandemic housing boom fizzled out in 2022, the national power dynamic has slowly been shifting from sellers to buyers. You see, this is the power dynamic based on two things: psychology of consumers, listening to the news versus experts and market updates like this, as well as though the decision making in these transition markets where people don't quite know what to do because it's a lot different from what we've done in the past or the type of market we've been in. Across the country, that shift has been varied significantly, and we'll talk about that in a moment. But this is what's really interesting about the two markets. Look at the Northeast and Midwest. There's actually more buyers in demand for the supply of homes. And if you watch our local market update here in Colorado from this month, you saw we started to see a decline in inventory already for the first time sooner at any period in the last 5 years within the seasonality of it happening earlier in a calendar year. But look at the South and the West. As you can see, there's a lot more sellers that are active in the market than the estimated number of buyers. So that's what I mean. The South and the West compared to the Northeast and the Midwest are completely different markets. And I hope that for everybody just looking at this graph goes, wow, that is not what the news is telling us. They're saying they are in a buyer's market, but the reality is the Midwest and Northeast are in a healthy market. The South and the West continue to see the greatest inventory gains and the sharpest market slowdowns with longer time on market and more frequent price cuts. The Northeast and Midwest remain relatively tighter by comparison, but are also gradually moving toward more buyer-friendly conditions. So this is the big takeaway from this month's National Housing Market Update, is using language more accurately. We're seeing buyer-friendly conditions, which is an amazing thing, knowing that inventory is still down quite a bit from pre-pandemic levels. So as you look at, again, months of inventory dictates the likelihood of home prices continuing to rise. The days on market of a specific home dictate the value of a specific property. But look at where housing inventory is growing the fastest. As you can see, in the South and the West, they actually have more inventory than they even did pre-pandemic. For many people who follow our local market updates in Colorado, we were at 0.2 months of inventory, meaning during the housing boom of pre-pandemic into pandemic levels, we would have taken about 8 to 9 days. And if nobody decided to sell another home, there would have been no homes to purchase based on the demand. So you can see how unhealthy that was. And in the Midwest, we still have 40% less inventory than we did pre-pandemic, which was 2017 to 2019. All these things is why it's very important to remember that we're still in a place where we need to see roughly about 2 to 3 million more homes on the market to get to the level of where we need to be in a healthier market. The inventory change compared to pre-pandemic, as you can see, the shift from 19 to 2025, nationally, we're still down by 13%. So prior to 2019, there's still 13% less homes available in the nation. But look at some of these other markets. You can see, again, Colorado, 30% less, Texas, 32%. All these areas have a lot less inventory available to where they were pre-pandemic. So at the metro level, 13 of the top 50 metros now exceed their pre-pandemic inventories by 25% or more, all in the South or West regions. On the flip side, 17 of the top 50 metros still lag at least 25% below their pre-pandemic inventory norms. So all of these things, when we look at inventory, lead to what will most likely happen with home prices based on supply, demand, and then remember that indicator of interest rates that usually bring a lot more people into the market. So the local markets where buyers and sellers have the most power, as you can see, sellers have the most power still in like New York, Ohio, areas of such, okay? Buyers have the most power in Florida, Georgia, North Carolina. These are all areas to be mindful of to make sure that we're not talking about all markets being treated the same. And what's really interesting as you look at this slide right here is that over the last 5 years, the average home has appreciated in value by 55%. 55% increase in the average home across America. So when you look at this report and you take, let's just say Denver, Colorado, where year over year from June to June, remember though, June to June is not taking the same account of what will January to January be. January to January most likely show home price appreciation, again, at that lower rate, 2 to 3%, which is healthy. Home values going up every single year, 2 to 3%, align with always and what has stood to be true, which is long-term investment is the number one choice of investment for Americans, and that is specifically in real estate. However, if homes go up 10, 15% like they did during the pandemic, that is unhealthy. And so as you look at 55% increase to give back 2% or 1% like Seattle, Washington, yeah, year over year, home values are down 1%, but they're still up 54% over the last 5 years, which is why many sellers are still deciding to sell in today's market because they're up and they're up quite a bit. And that doesn't mean rush to the market because you're seeing negative 2%, all right, year over year. As we start to see this inventory decrease again and get back to a healthier market, we'll start to see those 2 to 3 to 4% increases. And then some of these hotter markets, maybe 3 to 5%. And as some cool off like Austin and Tampa, they're down 5% right now, but they were greater than 55% over the last 5 years. So these are all very important discussions and why we provide you the National Housing Market Update. So that way we've got context versus just the extreme amount of content that's online that's misleading. Now, many people are asking with the recent rate stability benefits buyers and sellers. And what do we mean by that is like, what is the benefit to rates staying stable? Well, mortgage rates have moved within a narrow range for the past few months. Rate stability, improving inventory, and slower house price growth are an encouraging combination. What do you mean by that? They encourage a healthy market to where individuals do not react so much to the volatility of change. And this is why the desire for interest rates to drop quite a bit to where we used to be would actually be a negative, which is why most experts, and as you follow our national housing market update, you already know that this month they're predicting that the lowest that most likely they'll be by this time next year and even through the rest of 2026 is right around 6.1 to 6%. So looking for a large rate drop is unlikely to happen. And it's because we've been trying to sustain these levels to get people back to a level of normality. And as you can see, just over the last couple months, but really over the last couple years, hovering between 6 to 7% is a great place to be. What was very disappointing for many people is when they started to see it hover into the sevens, and that impacted affordability quite a bit, which we'll show you here in a second. Now, analysts, economists, and mortgage professionals are coining this quarter's activity as one of the most calm periods for mortgage rates in recent memory. And calm is good. It's peaceful. It allows you to make decisions that are based more on everybody else doing something and deciding, are you living in the location you want to live? Are you around the community and the people that you like and that you want to surround yourself with? And if not, the ability for both sellers, buyers, maybe not so much opportunity for investors, but there's always opportunity for investors. That's because that's what they do. They invest in every market. But buyers and sellers shouldn't be trying to time the market perfectly. They should spend time learning about it. Thank you for giving us your time. And then when you're ready, figuring out a strategy quarter by quarter on, is there a better month within that time period to take advantage of some of the opportunities based on most likely the lack of knowledge of real estate professionals and or individuals in what's transitioning or happening in the market. So borrowers should find comfort in the stability of mortgage rates, which have only fluctuated within a narrow 15 basis point range since mid-April. This is fantastic. It's a very, very, again, sustainable, safe, healthy place to be as you're looking at real estate. As we talked about, it's a buyer's market in headlines, but we know it's really a seller's market based on inventory. There are friendly buyer conditions, and that's why buyer demand is up slightly this year. As you can see actually in this graph from 2025 to 2024, the mortgage purchase application index, which is an index that measures mortgage purchase applications, is actually higher in 2025 than it was in 2024. And a lot of that is just because many people are now becoming aware that there's not going to be a large change in mortgage interest rates. And so Daniel Hale, chief economist of Realtor.com, said, I expect a generally downward trend for rates this year, but at a slow enough pace that it might not be noticeable in any given month. And that's the challenge, is we've been seeing so many monthly changes that have led to dramatic news or headlines with misinformation or misleading. And so as you can see here with the major bank projections, the only one, Fannie Mae, projecting 6% by the end of 2026. So right now with buyer-friendly conditions, your ability to actually negotiate a interest rate reduction lower than 6% is a higher probability being in the market today than seeing that rate change over the next 18 months, which is why so many people are taking advantage of their market as a buyer right now due to the fact of a lot of people not knowing this information. And so even incremental small changes, though, in mortgage rates will bring more buyers. It's true. I'm sure that you or friends that you've talked to have said, I'm going to wait for interest rates to drop. The challenge is, wouldn't it be nice if every one of us had this information and said, gosh, that's not the interest rate I was looking for. I was thinking like 5%. And knowing that there's no probability of that happening in the next several years, I probably should go take advantage of it now. And as you can see, though, even small changes like from 7 to 6.75 on a $400,000 home save people, $65 a month. Now in Colorado, an $800,000 home, it's $120, or that could be $260, and $260 now is a car payment. So these are all things that people are evaluating. The nice part is if you haven't taken the time to learn about your purchase power, that is something that we can help you learn more about, which is purchase power is what would you most likely be pre-approved for? What are the market conditions actually a benefit in supporting you to have more power in purchasing? And then what are sellers willing to do to negotiate certain terms, knowing they're up 50% and they're happy to give a little back right now? So trying to time mortgage rates is really difficult. There's no guarantee that rates are going to be any more favorable in 3 months or 6 months. And that's why for potential home buyers, it's important to get quotes from multiple lenders for a mortgage, as rates can vary dramatically. And if you're looking to get some of the lowest rates and or best loan programs, again, reach out for a strategy call. And we're always happy to help advise you on where you can start taking steps to learn more about the market. So then that way, when you are ready, that's technically timing it. But for most people, if you look at the last 30 years and ask when was the best time, it was yesterday. So please don't wait without a strategy. Hoping is not a strategy, but spending time learning about the market is. And so, as always, we are very grateful for your time and hope that you enjoyed this month's edition of Keeping Current Matters. As we know, those that know what's happening in the market have the ability to make a decision, which is one of the best feelings when it comes to your living situation.